Hi everyone, welcome to the weekly power sector review, and today is January 24th, 2022, and we're going to go through and take a look at kind of the sector and subsector world, see what happened there last week. Now, if you watch our macro videos, you know that we go through the market weighted sector proxy, the equal weight sector proxy, and the small cap sector proxy, and kind of look at them individually as well as kind of where differences are within these. But today I'm going to show you how I do it another way, is that I go to another page we have on our site, which right now it's under the More tab, Custom RS Snapshots, but this will eventually have a tab for itself so you can get to it a little quicker. But this area is an area that you can go in and actually enter your own tickers in and then rank them with our relative strength rankings. Whatever list you have, I think right now it's set up to 150. We're going to be making some adjustments there as well. But this is something that I do from time to time, is I take the three lists from the last page, the equal weight sector proxies, the small cap sector proxies, and the large cap or market weight sector proxies, and I put them all in one list and kind of rank them together just to kind of see what we see. And in this one, we still obviously have your energy leading, you have your consumer staples up here, and then utilities, and then materials kind of in the realm. The movers this week were the utilities, similar to we have with our other sectors, which we'll see here in just a couple minutes with our equal weight sectors. But this is an area to where if you're kind of looking and seeing how things are moving differently than the others, that you can come in here and take a look and see what your best setups are. Now, if you notice, we switched this to our 12-month relative strength rankings. While energy is still on top, some of our real estate start coming up a little more in the financials up here now, but you still have right here and stuck in the middle too is your consumer staples. And look over the 12-month rankings how they are moving up nicely. So this is an area that might continue to be in focus for us. Now, if we move over to the universe page, we'll start with our equal weight sector rankings. And here again, energy, consumer staples, and utilities, very defensive than materials. Now, utilities were the big mover this week, so we'll take a glance at them as we get on through. But that is, again, just on our 3-month. If we back out to the 12-month, we're still energy, financials, materials. So financials, while having a very weak couple of weeks, pulling it down in the 3-month ranking, is still up there in the 12-month ranking. So it's something that's kind of that the longer term staying strong, the shorter term weakening kind of gives us an idea for potential pullback, see where the support might lie. When we go down to the subsector, energy still dominates, financials are up here as well, and then some utilities. Now, our biggest mover here was electric utilities, up here in the 80s, but we also see precious metals moved up a good bit in materials from 37 to a 78. And if we rank this by gains, was our only positive subsector on the week. Now, next from that was utilities, as they made a pretty big comeback. We talked about last week about them being one of the weaker areas, but with the markets pretty much getting wholesale sold this week across the board, the correlations really went up this week. And seeing that happen, it put us in a position to where this was just kind of more of our least losers as opposed to even gains. But it makes sense with utilities, which again are a less volatile sector anyway, so we wouldn't expect them to see as much downside volatility as some areas like household durables, that just housing took it tremendously over these last few weeks, is all the way down to a 10 relative strength. So this is something we were looking at and trying to make sure that we want to keep an eye on which sectors are performing and which are getting hit the hardest. Now, I don't think you make much out of this until we do start to see some buyers come in and see which one of these try to bottom first, see which one of these try to get some positive gains, and then obviously we'll look into the breadth in each one of them as that happens as well. For today, though, let's switch over and just see how extreme some of this is. When I look at our quick RSI view, one of the templates or one of the spreadsheets that we work with, this shows the price is the first column. The second is the MA bands that we have. Only thing really significant here is we want to see price over the MA bands for more advantageous moves. RSI, then your 9 SMA on RSI, or what we can call our nitrous, and then the CFG. Now, when the 9 SMA of RSI is over 60, we consider that being on nitrous and in a strong trend. We have a few pretty odd scenarios here, like with industrial metals, also down here with regional banks and thrift and mortgage, is that where we have a 9 SMA of RSI still over 60, so still on the nitrous, with the CFG in negative territory, which is deeply oversold, especially this thrift and mortgage at a negative 22.7. Notice the RSI is pulling right back to 39.3, just below our 40 level or our range shift demarcation. So if it can turn up here, this might be an area that gets a little bit of thrust, just due to how stretched it is on the downside. So from an RSI standpoint, we can see CFGs, many of these are negative, getting into the pink and red zones. The ones that are holding up the best, obviously, are still energy and some utilities here. Now, when we flip over to our short-term breadth spreadsheet, it is much more red. We talked a couple months or a month or so ago about how when it got pretty red, you're pretty close to some kind of a snapback type rally. Certainly not necessarily to the day, but closer than or sooner than later is what's most likely here. And as we see, we have the percent making 10-day lows. Many of these are in the 50-60% range and in the hard red. Many of the percent above the 20-day moving average are in the hard red, which are below 5% or below. And then you see, obviously, the pink is pretty much everywhere. So we're in a position now to where the market got just washed out last week. There was a lot of throwing out the baby with the bathwater type selling. Could continue a few more days, but this is where we start to see the potential for a strong snapback. And then we can start seeing which sectors are getting the most attention first. We want to pay real close attention to these short-term breadth and these scenarios as the markets start to improve out of here. So going to the top sector, energy is still it, but see, again, this is one that even got caught up in the selling this week after trying to break out. Potential failed breakout here, still in RSI bull range, but pulling down to zero on the CFG. So in the MA bands as well. So, it might overshoot this a little bit, but if we can find some support above this little previous breakout area, the internal breakout 550-ish, somewhere in there, then we might look for this one to continue to hold strength. We can't count on any newcomers taking over the relative strength yet, because again, until we see the bounce or until we see something just not falling at all as the markets are pulling back, those are the only areas that we really can look for strength in until the charts and the data shows us. In the financial sector, again, it had been pretty strong right up against breakout level, and this week just got taken to the cleaners. CFG went down well negative. We're at negative 22 now, which is pretty deep, with the RSI just below 40. This could end up being a spike and come back up if we can find some support here. But again, all these are ifs until we start to see the markets prove themselves out. I did want to show banks themselves, one that did actually break out and got kind of the failed breakout and then got pulled down by earnings. It's right back in the MA bands, still in an RSI bull range, and CFG getting near oversold. So these are some of the things you might want to be watching if you think some of this inflationary or some of these areas that have been strong up until this last week's sell-off will continue to lead. I think that could certainly happen, but I want to wait and see where that money goes, because we can see within a day or so, if we're watching these types of numbers, the data, the breadth, and the relative strength. So in looking at here, we're going to skip the thrifts and mortgages, although its CFG, remember, was even more oversold. The materials sector, however, had been performing pretty well too, and looked like it almost made its another type of double top, as we saw with energy in that area. It tried twice here and it got turned down. But if we back out in this pattern a little bit, it's still kind of right in the middle of its pattern. We don't want to see it lose this 882, 880 area here, but it is, again, one of the areas that had been staying a little bit stronger. Consumer staples, we mentioned it on the ETF side a few times. Excuse me for pulling this up quickly. But if you look at the breadth here, it's still holding up pretty well, 60-something% over all the moving averages. The summation might be about to turn, we're not sure, but so far the oscillator has held. So this one still has a bunch of new highs, still moving higher on a lot of the, so this would be our strongest area to see. Might not be the strongest bounce back out of the lows, but it might be the most durable activity if we do see it perform. Now, there's a lot of people calling for this to pull back because it had been so strong while everything else is weak. And that certainly could be the case as well. So we want to watch on both sides and make sure that if you're trying to enter anew, that you're finding a good spot to work against, just in case the markets go into, again, a one correlation and sell everything off as kind of an end move. Utilities had the most gains this week. This one right here is looking like it's just right back mid-pattern, very defensive player, and it did get sold off with everything else this week, and it is kind of towards these lows with RSI breaking down and CFG right here below zero. So if it doesn't bounce, we're likely to see the bottom of this range. But if markets do, and this can hold on, this could be one of our areas that's worth watching and seeing if it can get some new flows in from a longer term stance. Now, if that is to happen, then that means that the overall view is still more bearish, because people aren't going to be putting a bunch of money in utilities out of a bounce play if they think the markets are going back to strength and running there. So this is also kind of gives us an overview depending on where that money flows next too. Okay, that's where we're going to wrap things up today. I hope that gives you just kind of a general idea of what's going on in the markets. Again, it was a very high correlation week last week. Everything got hit pretty hard. So we really do want to wait and see some money flow back into the markets and see what areas it's flowing in before we make any big decisions on what looks best. Right now, there's not a whole lot that looks great unless you are looking at some of these defensive plays that pulled back last week, finding some near-term support. But even with that, in this kind of market, let's make sure they actually find that support and buyers show up at least intraday before we start getting too excited about any change. All right, hope this helps. Hope everybody has a great week, and we will talk to you soon.